CRCL went public at a $7.2 billion valuation. Most investors think this is just a crypto bet, but if you break down its organization, it starts to look more like BlackRock and Stripe had a baby. So what are you really buying when you invest in CRCL? CRCL makes money in 3 very different ways. The first way, USDC issuance plus reserves. They issue USDC, $1 in, 1 USDC out. That $1 is held mostly in short-term US treasuries, earning 5% plus interest. They earned $779 million in interest income in 2023. That's over 40% of their total revenue. Structurally, this is a money market fund. This isn't Web 3 innovation, this is Web 2.5 collecting yield like a boomer with a Bloomberg terminal. Second, API and treasury services. Businesses can integrate CRCL's API to accept USDC and automate treasury operations. Think of it as Stripe for stablecoins. This is the fastest growing part of the business and deserves a fintech-style valuation multiple. It's like if Stripe and a stablecoin had a late-night GitHub commit, and 9 months later, this revenue stream showed up. Third, mint and institutional access. On-off ramps for large clients to mint and redeem USDC. Critical but low margin. CRCL is founder-led by Jeremy Allaire, with major backing from BlackRock, Fidelity, and Coinbase. No shady offshore operations. Reserves are transparent, custody handled by BNY Mellon, audited monthly, regulated in the US. Compare this to the other company I'm not going to say who, which hides its banking relationships. And suddenly, CRCL structure commands a premium. Also, no dual-class shares here, which means if you invest, you don't just get diluted, you get invited to the dilution. Alright, let's talk numbers. In 2024, CRCL brought in about $1.68 billion in revenue, with net income around $155 million. Now here's how that revenue breaks down. Roughly 60% from interest on reserves, USDC money parked in treasuries. The other 40% from platform business APIs and treasury services. Let's break it down. First, the reserve interest business. Basically the money market fund side. It's stable, but low growth. We apply a conservative 2x revenue multiple on that $1 billion segment. That gives us a valuation of $2 billion. Second, the API and platform side. This behaves more like a fintech SaaS company. It's growing faster and offers recurring income. We apply a 6x revenue multiple to that $600 million, which gives us $3.6 billion. And third, there's the strategic infrastructure, things like CRCL Mint. It's essential, but not a big revenue driver. We'll give it an optional valuation of about $500 million, just to capture its importance in the ecosystem. Add it all up, and you're looking at a sum of the parts valuation, somewhere between $6.1 and $6.5 billion. So the IPO price of $7.2 billion, slightly expensive, unless they can 2x the API business over the next 12 to 18 months. That $7.2 billion tag? Think of it as buying a used car. If the turbo kicks in next year, it's worth it. If not, it's just a Prius with attitude. You're not buying a crypto moonshot here, you're buying a stable, slow-growing reserve business with a high-potential fintech engine strapped to it. So let's talk scenarios. In the upside case, the Fed keeps interest rates high, so CRCL keeps earning strong reserve yields. USDC adoption grows across wallets and platforms, and CRCL's API becomes the Stripe of stablecoins, embedded in every fintech app. But here's the downside. USDC could lose market share to PayPal's stablecoin, or even backslide against Tether. Crypto regulations might tighten and squeeze revenue. And if interest rates drop sharply, reserve income disappears overnight. If this breakdown gave you a clearer picture of what you're actually buying, not just the story, but the structure, consider subscribing. This solo nerd will genuinely be grateful.